Hi, my good friends. We are welcome once again. And I want to say congrats to, or a good job to all of you who have been watching the videos, who have been taking the time to practice. I went online to look at the engagement, and I can see a good number of you are still engaging. That's excellent. Okay. So, once again, please, to make your learning more useful, to make you better understand the FA3, the finance, it's more of a advanced financial reporting. Some settings will say advanced financial reporting. To make it more relevant, please look out for other books, other texts, and they give you further insight on this topic of consolidation. Consolidation can be tricky sometimes. Okay, it can be technical, and so for you to be able to better understand the mechanics, the technicalities, the complexities, please try other texts. Okay, use other texts to match up the core text. The ACCA text we are using is good. Okay, but I can say for sure that it is not holistic. Okay, there are some other texts that I read, and I want to show you this text. Okay, for there's this text I use, and in addition, Global Financial Accounting and Reporting Principles and Analysis by Walter Edds and Peter Walton. This book also gives me different ideas and understanding on how to better understand the mechanics of consolidation. Okay, so there are more texts, and Jennifer Maynard's book is also excellent. So please, let's do that. Okay, so today we'll be looking at intra-group trading and then transactions and balances that arise from parent subsidiary trading relationships, subsidiary parent relationships. Okay, it's a family. Consolidation is like one family. So I'm giving money as a loan to my son, to my daughter. Do I have to treat it as something which has happened outside of the family unit? No. Okay, I buy some goods and services for my son or for my daughter, or my daughter buys from me, gives me a loan. Do I need to treat it as something that has occurred outside of the family entity? No, it is within. Okay, so we have to eliminate these intra-group balances and transactions. That's all we're going to be doing today. Okay, I'll try and split it into two. The first half would take the intra-group trading up to the inventory where we sell goods and services. Then I will consider the next part, which will be sometimes we can have assets. Once you acquire a subsidiary, sometimes parents will transfer some assets to the subsidiary, sometimes at some trading value. Okay, there's a profit component on it. How do we deal with these profit elements on the non-current assets? Okay, sometimes also, I will not go to that aspect. I'll highlight it quickly. At the end of the day, it's an investment you hold in the subsidiary. Okay, so subsidiaries sometimes will declare dividend. They will give you some dividends. Okay, what do we do with that? So I'll touch on that briefly in passing, then we go. Okay, so these are the two elements we'll take. Also, after this, we'll look at another section altogether, and it's something we've omitted from our books for long, from our teachings for long. And so when students get into the exams and they see such scenarios, they panic. Or sometimes the students can understand, but because they've not been taught that element, they panic, they make mistakes. Okay, and so that is when there are mid-year acquisitions. You should know that acquisition of companies do not normally start at the beginning of the year. So if my fiscal year starts from 1st January and you are coming to acquire my company, sometimes you acquire it in March, in April, middle of the year, partway through the year. How do we deal with this? It's so easy. Very, very easy. We just have to prorate. Okay. So be careful. Look at the date in the question, the reporting date, the acquisition date. That's the next section we will take. And then we'll end it for this particular week. Okay. So we look at the unrealized profits and we look at mid-year acquisitions. And we end it for the week. Okay. All right. So at this point, I'll go on. I'll share my screen. Once again, I want to assure you guys that there's nothing difficult with this module. Okay, it's just some few technicalities here and there that we'll meet, but there's absolutely nothing difficult. Don't worry about the balancing of your accounts at the end of the day. It's about getting more of the transactions correct. That's the most important. Okay, the transactions are important, but of course, if you get a deeper understanding of the transactions and how it is treated, the mechanics, you surely end up balancing it very easily. Okay, all right, let's move on. So at the end of the day, still same learning objectives, and I've highlighted the ones which is of utmost importance here. So trying to look at how and why is it necessary to eliminate these intra-group transactions, okay? And it's because, yes, we need to all adopt a uniform accounting policy. We want to look at dealing with using uniform accounting policy. So I'll leave it basically the same thing we are building on from last week, okay? Same learning objectives, okay? So I'm bringing this up as an overview. So in terms of a group engagement, all intergroup, intra-group balances must be removed. Okay, if I've given a loan to my subsidiary, it's a form of an investment. I get interest. You got to eliminate that. Okay, if there's any receivable, any trading payable, receivable, even if there's a dividend payable to the parent, you have to get rid of that. Okay, what if I have bought from my parent company and I'm yet to pay? So the goods, the cash is in transit. I've sent the cash. It's not get yet hit the account because sometimes when the amount gets to the bank, it will go through clearing 3 days before the check clears, gets to you. Sometimes when I've shipped the goods from the parent or from the subsidiary to the parent, what happens is that it takes some time, 3, 4 days, 5 days. It's not yet gotten to the parent or the subsidiary. What do we do with that? How do we do with it? Okay. So of course there will be unrealized profit, provision for unrealized profit. We need to adjust it on the inventory, okay, and then on the payable. So I'll take this part as the first part and I'll deal with this with the second part. But we are going to be taking the whole of the narratives, okay? The narratives on this. We'll look at the narratives on all of this, okay? And then we move on. So we'll look at the narratives that cover these. We'll look at illustration questions along the side, along line, okay? But at the end of the day, we'll cut it off from here and we'll take the second segment. I want it to be quite brief as we can. Okay, so the basic mechanics is that remove both the assets and the liability. Receivable, payable, remove them. Okay, where the assets and liabilities are not equal, you then need to adjust for any goods in transit, any cash in transit. Okay, because once we've dispatched the goods, we record it in our books. But because I've not received it, I may not have adjusted it in my books. Okay. So what is accounting for the difference? The cash in transit, the goods in transit. Okay. So any goods in transit will require subsequent provision for unrealized profit adjustment. We'll take an example you will understand. So like I said, sometimes cash is paid or goods are dispatched by one party within the group before the year end, the reporting date. But I may not have received the goods or I may not have received the cash. What do I do? Okay. Okay. In that case, you see that the intra-group balances will not jive. But we need to adjust this and amend it and then reconcile them by canceling it out. Okay. All right. So make sure if it is 10,000 on this side, it ends up 10,000 on the other side. Else, your books will not jive, will not balance. Okay. So in order for us to realize the group profit, the sales, especially for goods, okay, for inventory dealing, the sales must be made to a customer outside. If you want to recognize any profit, it should be outside the family unit, outside the group. Okay. So in the underlying individual accounts, intra-group profit is included in the profit figure of the individual income statement, and then the result and result of the individual company. All right. But in terms of reconciling these intercompany balances, we must make sure they balance, they jive. Okay. First and foremost, we should always look whether this transaction is occurring outside of the group, to the outside world. Okay. If they are, we record it. But if they are internal, then we have to adjust it. Okay. We need to adjust it. Cancel them out on consolidation. Okay. And then wherever the adjustments are, we'll try to see how we can adjust and make sure they jive. Okay. Cancel them out. Easily the main thing we want to say is cancel them out. All right. So let's take, I've given a summary notes here, overall, the summary notes. So, and I picked this from Alexander Jorison and colleagues, is their book on IFRS. It says that, listen, on consolidation, and IFRS 10 will give you this. On consolidation, IFRS 10 requires all intercompany balances to be eliminated, okay, where sales have been made between two companies within the group. So sometimes, remember, it will not only be parent and subsidiary. At this point, financial reporting, we are dealing with one subsidiary. Remember, in an advanced scenario, strategic business reporting by the SEC, you can get two subsidiaries, three subsidiaries, and you need to work this. We are not getting to that level now. We are only limiting ourselves to one single subsidiary and a parent. Okay. Now, if it happens between the parent and the subsidiary, it is necessary for us to provide for unrealized profit from intra-group sales. Okay. To the extent that these inventories have not been sold at the year end. Okay. If they've not been sold at the year end, we need to provide for that. But if they've been sold, that makes life easy for us. Okay. If the sales were made for cash, then the cash in the seller would have increased, right? I sold, I got cash, whether from the parent or the subsidiary. And the cash from the buyer would have decreased. Okay, but remember, it's the same family. I give cash to my daughter, to my son. My cash reduces, his or her cash increases. On consolidation, there's no adjustment required. The same story is happened. You've already cancelled it out. You want to give yourself so much trouble, you can cancel it from here and add it to this. It's still okay. Okay, depends on the argument you give. Okay. But if the invoice has not been settled, then you know one person is owing the other. There is what? There is a receivable. Okay, in the seller's account. And then the buyer's account, there is a payable. We must cancel them out. Okay. So make life easy. When I have paid the person cash, parents, if parent has paid cash to the subsidiary, parent's cash has reduced, subsidiary's cash has increased. Leave it. It's already cancelled out. Okay. Unless you want to give yourself that headache, you can cancel it out from the receiving end and add it back to the giving end. Okay, it makes sense. But if it's not for cash and there's an element of someone is owing, the other person has received, is owed, then we need to balance them out and cancel it out. Again, therefore, what we're saying again is that all intra-group payables and receivables must match each other and cancel out. And we have to show the workings on the face of the books. Okay. For example, if the subsidiary company has also declared a dividend, like I said, I'm saying this in passing, before the year end, it will appear in the current liabilities of the subsidiary. Usually, yes. And then it will also appear as a current asset in the books of the parent, right? We must set them off and cancel it out. Okay, we must set them off. So if you see clearly in the books, dividends payable to parent, and then in the parent's book, you've seen them written dividends receivable from subsidiary. They must match out and cancel them out. If there's any difference, then it may account for maybe dividends paid, some dividends paid, which the other party may not have received. Okay. All right. So that's in passing. Will not look much. It's just an easy calculation. Okay. Again, on the same case of the dividends. Okay. If in the case of dividends declared by the subsidiary, if the subsidiary is wholly owned by the parent, then the whole amount will be cancelled out. The whole amount will be cancelled out. But if there's a difference, if I'm owning part of the company, of the subsidiary, there's a non-controlling interest element, right? Therefore, the non-cancelled amount of the dividend payable in the subsidiary's statement of financial position will be the amount payable to the non-controlling interest and will be reported as part of non-controlling interest. You get what I'm saying? What I'm saying is that if the parent owns 80% of the dividends of the subsidiary, okay, and the subsidiary has declared 100% dividends, okay, let me just put that. If the sub has declared, okay, declared a dividend, okay, declared a dividend of, let's say, 100 million, okay, and then the parent owns 80%, okay. In the books of the parent will need to get what? 80% of the 100 million, which gives him 80 million. These 80 million, we need to cancel it out from that portion of this 100 million. The remaining 20% NCI will account for it. Okay, so NCI will get 20% of this 100, which means he gets 20 million. And we need to include this in the NCI figure. Okay, the NCI equity figure. Okay, equity figure in our statement of financial position. Then it will jive, it will knock them off. Okay, so that these whole elements will now be accounted for 80 cleared, and 20. And you can see that the transactions will balance. Okay, all right. Where the final dividend has not been declared by the year end, there is no liability under IAS 10. If you remember this from your FA2, Financial Accounting 2, events after the reporting date, okay, IAS 10. We'll brush it over getting to the end of this particular module, okay, not much, we just brush it over. Okay, so when the final dividend has not been declared by the year end, there's no liability, right? And so no liability will be reported. So companies will need to make a reference. So there will be no need for any cancellation of any intergroup balances, okay? But the company must clearly indicate a reference to these adjustments in line with the accounting policies and footnotes in line with IAS 8, okay? Estimates and policies and accounting errors. All right. Now, transaction between groups, including intra-group receivables, income or expenses, unrealized profits, unrealized losses, they must all be eliminated in full. Okay, we'll look at this in terms of financial position presentation, and then when we deal with the consolidated income statement, we'll look at same scenario over there and see how we can knock off any element of sales which has been conducted between the two parties. Okay, let's move on. So an example of intra-group trading, okay, of intra-group trading and unrealized profits. So activity one, we have land, inventory, debtors, and then investment in B at cost 275. Okay, they've told us plainly. So company A owns 75% in the shares of company B when the reserves, the retained earnings at acquisition during the time of acquisition in B were 200,000. Okay, so we can realize there's a 200,000 here. At the reporting date, I can see the B reserves is 524. So clearly my post acquisition will be my 524 minus my 200, right? Okay, so we got our 324. You can keep that one down. Normally, if I'm working these questions, I try to put down some notes just to help me. Okay, during the year we are told, so everything now stands out. We then know that this investment at cost in B. Okay, this investment purchase consideration. So we can use that one to cancel out, okay, the equity shares. Okay, now we look at the pre-acquisition as reserves. Okay, during the year we are told that the subsidiary sold goods to A at a profit margin of cost, margin of 25% on cost. Okay, 50% of these still lie in A, in the parent's closing stock. So not all have been sold. If all have been sold, makes life easy. But now they've not all been sold. If all have been sold and it goes outside of the company, then we recognize it. But we are being told that 50,000 of these still remains. So it's still within internal. We got to take them off. Okay. So remember what comes in here. Prepare the consolidated statement of financial position. What I want us to know is the element of what markup and margin. Okay. You may remember your markup and margin formula from college or from senior high. Simple. Okay. So we know our markup is always giving us what margin. Okay. All over what 1 minus what margin, if you remember this. Okay, and then our margin is always giving us what our markup, which is normally will be in the question. So you find a markup, okay, a markup all over what 1 plus what the markup again. You should remember this. Okay, all right, okay, all right. So here, what do you see? They said there was a margin of 25. Okay, so we're going to have our 25 over 1 plus our 25%. Okay, percent, I mean. So you can get 0.25 over 1.25. You can even still keep it as 25 over 125 and it should jive. Okay, it should still jive. Okay, all right. So we'll keep this at the back of our minds. Now I've populated all the workings there, but I'll take it step by step. Okay, so now let's take the first step, the goods. Okay, the goods. I'll go for note 1 first. Okay, so the goods in transit, the goods in stock, sorry, in stock of the or delivered by B in stock in the stocks of the parent is still 50. Okay, so Don't worry, like I'm saying, I've given you the markup formula, but you could use any alternative means to calculate it. Okay. If you take other books, they give you alternative means. So I intentionally plotted these two different ways. So you can find a profit margin by simply 50,000 minus 50,000 over 1.25 markup and margin formula, and it gives you 10. These unrealized profits. Okay. What they are saying is that, listen, that we send goods, we sold a certain amount of goods to the parent. That price was not given to us in the question, but they told us that the original cost of the goods plus 25% gave us 50,000. So what figure? You can use simple ratio and proportion also. Simple ratio and proportion to calculate this. A certain figure, 25% plus that figure gives us 50,000. What figure is it? Okay, simple proportion, ratio and proportion will give you. So it tells you that this 50,000 represents 125%. So what is the 100%? And if you find the 100 simple ratio and proportion, you see that if 125 is equal to 50,000, then 100% will be what? Okay, so 125% is equal to 50,000. Therefore, 100% will be what? Okay, so 125% is what? 125% is 1.25. 100% is 1. Okay, so you can do simple cross multiplication. So you get your figure to be what? 1 times 50,000. Okay, all divided by what? 1.25. All right, and then you realize that 50, 1, 2, 3 divided by 1.25 gives you 40,000. Okay, gives you 40,000. So what we are saying is that that figure, the original cost was 40,000, and then we added a markup, okay, a markup of 25%, which give us 50,000. So there's a profit element that we have included, which is 10,000. All right, which is 10,000. So I use that simple ratio and proportion to work for this. Okay, you can use your markup formula. Again, I did it. Markup is over 1 plus the markup. So 0.25 plus 1.25. Okay, and then you multiply by the 50,000 and it gives you 10,000. Same. Okay, so what do we do over here? There's an unrealized profit element. There's an unrealized profit element. How do we treat it? Okay, twice. We treat it twice. Okay, let's start again. So now, once we've gotten this, let's mark it down and let's move on. So we can calculate our goodwill, all right? The purchase cost, the fair value of the consideration was given in the question, 275, okay? Then we look at the, remember we owned 75%, so we look at 75%, we less the fair value of the identifiable net assets of the subsidiary. So it is 75%, let's go back one step. You see the equity shareholding of the subsidiary is 100, right? So it's 75 times the 100. Okay, times the 100 gives us what? 75. It means the NCI would take 25%, which is what? 25% of the what? The 100. That gives us the 25. You understand it? You can always open your worksheets, okay, your working papers. Once you deal with this first side, you deal with the other side. Then you keep working. All right? It depends on your approach. It depends on you, okay? Then the pre-acquisition or the reserves at acquisition. The question says it was 200, okay? It was 200. So again, 75% of this will give me 150. Okay, 150. And then I add the two, I get 225, subtract from the 275 I paid, I got a goodwill of 50. There's no impairment in the question, okay? There's no impairment in the question. Now, we move on. What about the group reserves? Remember, for the group reserves, the first thing is to pick everything of the parent. Sorry, one step back. Everything of the parent is what? 1045. And then we add any post-acquisition reserves, okay? So, ordinarily, it would have been 75% of the, you remember I plotted this one here. I said it is 524 minus 200. So you get 324. Ordinarily, it would have been this if there's no unrealized profit. But the question is telling us that there is a certain profit element because who sold to whom? Okay, who sold to whom? The subsidiary sold goods to the parent, and the subsidiary had recognized some 10,000 profit, which had been recorded in his retained profit, retained earnings. Okay, but we need to get rid of that profit. It's a family business. It's a family thing. Take out the 10,000. Okay, so our 324, which we would have had ordinarily, minus the 10 unrealized profit. Okay, then we find 75% of it, which gives us this amount. Okay, then that's it. No impairment of goodwill for us to take a portion of it. Okay, no fair value here. So we just take everything easy, cool. Okay, and then we add, and this is the amount that we take to consolidation. Okay, so this becomes reserves on consolidation. Okay, on consolidation. Now, with the NCI, we got the first element right, quite easy. The same story happens. Okay, so the post acquisition reserves, okay, the 524, okay, 524 minus the 10, okay, times 0.25, okay, gives us 128. So for the subsidiary, make life easy by simply finding the percentage, the NCI's proportion of what the post acquisition reserves, and they get 128. Add it, you get 153. Okay, that's it. Very easy. Very easy. Okay. Now we just prepare our statement of consolidated um our consolidated statement of financial position. Okay. So goodwill, like we computed, plants and equipment, land and plants, we added two. Okay. And then inventory again, the 10,000 profit. They said 50 was still remaining in the inventory. Okay, 50 was still remaining in the inventory. So if you go to the question, you will see that we had inventory. We had inventory of 600 for the parent plus 400. Okay, but there's a profit element of 10. Get rid of it because it's still in the inventory. Okay, so we have to remove. So when you add a 600 and a 400, you get this 1,000. Okay, you get this 1,000, and then subtract the 10. The unrealized profit. Okay. Debtors, we add the two figures. Okay. Share capital, that of the parent only, the reserves which we've calculated, NCI which we've calculated, and then total equity, liabilities, creditors, add the two, and you get this, and it jives. Okay. And it jives. Okay. All right. So let's move on. Let's move on. In every question, we'll try and give you some element of goodwill calculation, NCI, so that it will get embedded in your mind. So for all tutorial, that's what we'll be doing. All right. Let's look at the second question again. So the financial year of two entities, A and B, within the same group is 31st. On 29th, 2021, company A dispatched goods to B to the invoice of 40,000. Okay. And charges B's ledger accordingly. B does not receive the goods until 4th January. Prepare the consolidated books in terms of adjustments. What do you do? Okay, so from B's books, B's ledger, what would they do? They'll debit goods in transit. Okay, B has not received it. So assume we'll receive it. Okay, so debit goods in transit. Okay, and then the corresponding will be what you credit A's current account. Okay, you credit their current account. That's it. Okay, that's it. Um, so you can say payable. Okay, you just record it. Okay, on consolidation, the respective deed of these amounts will be in agreement, and we'll cancel it out. We'll cancel it out. But the person has dispatched the goods to you, he will consider you as a payable, as a receivable. Sorry, in their books. You in your books, you consider him as a payable. Okay, you consider him as a payable. So credit the payable account. Okay, some you can say current account, okay, the payable account, and debit the goods in transit. But on consolidation, the two must jive, and you cancel them out. Okay, so remember the goods in transit will contain the unrealized profits. So once you cancel them out, it takes care of the unrealized profits. Let's take another example. Okay, still on the inventory. One more thing on the inventory before we take an example. So at the reporting date, if a group company holds inventory that has been purchased from another person, another party within the group, the profit within that inventory must be removed by what we call the POP, the provision for unrealized profit. Make provision. We've looked at one example. Okay, provision for unrealized profits. The impact is to reduce the value of inventory to the group cost and reduce the retained earnings of the selling company. So that we'll be reporting a fair transaction, not just fictitiously boosting our profits without recourse to considering the external transactions. People are reporting profit based on transactions they've held with external wealth. Why do we want to cook up figures within the company? Okay, so they say, let's remove it. Okay, let's get rid of that. Okay, so if the parent is a seller, then reduce the. So we started with W1, W5. So our standard workings for the ACCA. I intentionally use W5. Yours could be different. Okay, reduce the consolidated reserves calculation, the group reserves, reduce it. Okay, and where the subsidiary is a seller, if the subsidiary is a seller, reduce the reporting date column, the net assets of the subsidiary, reduce it. Okay, so whoever is recording the unrealized profits, what we are saying is that go into their books and then reduce it. If I've included it in my reserves as the parent, go into my reserves and reduce it. If the seller has reported it as part of their net assets, retained earnings, go into it and reduce it. That's all we're saying over here. Okay. All right. So let's take an example. Carl and Susan. Okay. Carl and Susan. So we are saying that on 1st May, Carl bought 60% of Susan. Extract of the financial statement at 30th November is given. So the inventory 15,000 and Susan 17. Ordinarily, we'll just add these two when preparing the statement of financial position. But we are told that the inventory of Carl includes 8,000. I'm making dollars and pounds, don't worry. The currency should be the same. Okay, of goods purchased for cash from Susan at cost plus 25%. Okay, markup, all right. Cost plus. So we are being told that certain cost plus 25% required. Prepare extract of the consolidated statement of financial position as at that day. So we're using still the markup margin formula. Okay, markup margin formula. All right. So there is a margin of 25 on the cost. Okay. So again, it will be 25 of 125. You can use percentage. Okay. You can use percentage and it will still work. Of the 8,000, which gives us what? 1,600. Okay. So what they are telling us is that the inventory includes 8,000. That 8,000 is a figure that includes a certain profit element. Okay, 25%. So we get it, 1,600. So in terms of preparing the financial statement, like I said, we'll add this and this, but we must get rid of the profit element which was included. Okay, easy, very, very easy. We must get rid of this. Okay, so that's what we found over here as 3,400. All right, so I'll end here for the first part. Okay, I'll end here for the first part, and then we'll look at the second part in terms of non-current assets. Don't worry, we'll still be giving you more questions to practice, so that the more you practice, the more the concept gets cemented in your mind. You'll be fine. It's very easy. We'll take a more comprehensive question, more tutorial questions, then you'll be fine. No worries, you'll be fine. All right. See you in the next session. Thank you. Bye for now.